Warren William here. Smartest data, quick definitions. Quantitative easing, tapering and tightening. Good or bad? Let's get to the video and take a look. Quantitative easing, tapering and tightening are open market strategies conducted by the central banks. The objective is to manipulate interest rates at the long end of the yield curve. Monetary policy is under the domain of the central banks. They control, set short-term interest rates, but long-term interest rates are determined by the market. The central bank in the US is the Federal Reserve. In Europe, it is the ECB, European Central Bank. Quantitative easing, being QE and QE2, are unconventional forms of implementing monetary policy. They are employed as short-term interest rates were already approaching zero. Thus, further reductions in short-term interest rates were perceived to have limited impact. Quantitative easing is where a central bank conducts a strategy of open market transactions over a long period of time. The central bank enters into the bond market to purchase long-term securities with the objective to push down long-term yields. The desire is to increase the money supply by encouraging lending and investment across the broad economy. The effects are twofold. First, this injects new money into the economy and lowers long-term interest rates. Second, it does expand the balance sheet of the central bank, which needs to be funded by the federal government. The period of quantitative easing and tapering are over. The next phase is quantitative tightening. Tapering simply means less open market activity by the Federal Reserve, still buying long-dated bonds, but less. Now, quantitative tightening. This occurs when the central bank starts to unwind or sell on the open market long-dated securities. In chemistry, they say for every reaction, there's an equal and opposite reaction. Let's see what quantitative tightening brings. In closing, 3 quick bullet points regarding quantitative easing, tightening. It is an unconventional form of implementing monetary policy. The objective in quantitative easing was to push down long-term yields to increase lending and money supply in the economy. The issue is this has to be funded by the federal government. In the Federal Reserve, their balance sheet is around $9 trillion.